further ado, thanks everyone for joining. We'll get started here. Really, the goal of today's webinar is to kind of fill you in on what's happening in Maine with respect to solar PV development under some new legislation, why you may have heard about this, why CES is bugging you about this, and why other developers may have called. So we'll start with a little quick introduction to CES. I think most of you do know us, but we'll do a quick introduction. We're going to talk about this policy that has really ratcheted up the opportunity for customers, explain how that works, talk about the opportunities available to electricity customers throughout the state of Maine, share some examples of projects that CES has worked on that are completed and will be constructed in the next few years, and a little bit about what we do to support our customers in this area. So starting with a little bit about CES, a lot of you know us for our procurement, energy procurement work. That is electricity supply, natural gas, liquid fuels, propane, oil, renewable wood chips or renewable fuel oils, really any energy commodity. We help with a competitive procurement strategy to buy those commodities. But what you may not know is we actually have a pretty sizable sustainability team here at CES and have for a long time now, supporting a group of customers that are interested in either alternative energies or managing carbon emissions, understanding the impact of their facility operations, and kind of from an environmental perspective, and then also in helping folks to manage and plan for the future. So one of the services that we do provide our customers relates to on-site and off-site solar development, which is the key topic for today. But we've done a lot of work in southern New England on this, and battery storage and fuel cells and cogeneration, wind development, you name it, we've touched it. And we're really gaining a lot of traction in this space for a lot of customers who are planning not just in the next 3 to 5 years, but really further out to the 10 to 30 year timelines, and looking at what the future may look like, what sort of demands they may be seeing from their customers, and really how to position themselves for that from an energy perspective. We've listed some of our key clients, both really trying to highlight some of the diversity of scale and public and private entities all across New England. Some large companies you may have heard of, Adobe, obviously a much more global presence, but Bowdoin and Colby Colleges, Hannaford's LL Bean, New Balance, the University of Maine and community colleges here. We work with a lot of large, both municipal and private entities, and bring a diversity of experience from each of these sectors. Kind of a nice little visual on the projects that CES has ultimately been involved with and helped to construct from a renewables perspective, primarily solar, and you'll see some battery and hydro facilities scattered throughout this map. But just to give you a sense of where our activities have been really driven by state policies in Massachusetts, Rhode Island, and now Maine. Just to make sure everyone is on the same page, we've certainly received and appreciate the good feedback we get, which is commonly that we use too many acronyms and jargon. So I'm trying to get ahead of that a little bit here to just define a few terms that may be helpful to get everyone on the same page before the presentation today. So first is a layup with a utility, local utility. Being really focused today is our electric utilities, the investor-owned Central Maine Power and Versant Versant is the formerly Amera or Bangor Hydro. They have two unique service territories that are in the Bangor and then northern Maine areas. So when we talk about a utility, it'll be referencing one of those two utilities. Second term here is a megawatt or kilowatt. This is often a sizing designation reserved for a generation system's nameplate output. That is the maximum amount of electricity that solar panel, for example, could generate. And we all know that that panel is probably not always going to be at its maximum output, but it's the theoretical maximum that a system, whether any type of generation, but in this case solar, what is the maximum rate of output that panel could, or panel system could achieve. A megawatt hour or kilowatt hour is when that panel of a megawatt in capacity produces over the course of an hour 1 megawatt, or if that's generating a megawatt over the course of an hour, it will generate a 1 megawatt hour of electricity. And so really a megawatt hour is the distance in a kind of rate times time calculation, where rate is measured in megawatts or kilowatts, time being an hour, and the distance is how far or how much electricity was generated in the form of a megawatt hour. That also converts to the load side or consumption side, where you may have a facility that is running at a megawatt load, and over the course of an hour you would consume 1 megawatt of electricity. Fourth term here, renewable energy credits. These are in essence the environmental attributes attributed to 1 megawatt hour of renewable energy generation. So this is the claim to the environmental attribute that is generated by a solar project, for example. And we'll talk a bit more about that later on, but really this is a distinct credit separate from the actual electricity megawatt hour or kilowatt hour that's generated. Lastly, and this is where we're really going to get into it today, is net energy billing. Okay, this is a program that was authorized under recent legislation, LD 1711. There are a few terms that we're going to use throughout the presentation to highlight here. The net energy billing rate. The rate is the price or compensation for each megawatt hour of electricity generated by these projects, these solar projects, for example. So for every megawatt hour, there's going to be some compensation rate. What is that megawatt hour worth? Well, that's the net energy billing rate. Okay, that's the rate, and the rate is really the driver of this opportunity. We've got a very high value under the new net energy billing rules for those megawatt hours generated. That high rate converts into ultimately a credit. That net energy billing credit is a function of the rate times the volume of megawatt hours, and that credit takes the form of a monetary credit on the utility bill. Okay, so the credit is what hits your utility bill. A net energy billing credits agreement, or NEBCA. This is the agreement in which a customer would enter to buy these net energy billing credits through this new legislation, LD 1711. So this will all start to make sense as we get into the presentation today. So we'll jump right in, talk about the legislation LD 1711. First to note that we have had a net energy billing program for a while. limitations of that prior policy really limited participation. Under this new policy, we have really 3 reasons that have made the new net energy billing program lucrative for participants. The first is the expansion in the eligibility of the system size. So you can now build much bigger systems that qualify for net energy billing. And the relevance there is you can get more economies of scale as you build larger system sizes. Second reason is the account limitation. There's an account limitation to, or under previous policy, there was a limitation to how many accounts could receive credits from the project. That is now unlimited. So there's no cap to how many accounts can receive credits. Lastly, and most important, is the net energy billing rate, which is applied through a formula, including both supply and delivery portions of your electricity bill. So that's really, in essence, the energy billing credit rate. Kind of the key to all of this program success is the value as it's indexed to the price of electricity. So that's a key part of understanding the value of these programs. So we'll dive a bit more into the net energy billing rate. Okay. Under this legislation, this monetary credit option is in addition to now what used to be both a volumetric kilowatt hour credit. Now we have a volumetric and a monetary credit option. The monetary credit option for most large customers brings additional value to that billing credit, that billing credit, yes, based on the rate. The formula for calculating that rate is the standard offer for the applicable account receiving that credit. Standard offer is the supply portion of the bill, plus 75% of the delivery charge for a small general service customer. Okay, it's a bit of a mouthful. In this example, we've assumed a standard offer supply rate for an applicable customer at 7 cents, the delivery charge for a small general service customer at 6 cents a kilowatt hour, and the combined total of that formula would lead to a billing rate, energy billing rate of 11.5 cents per kilowatt hour. These rates will be reset annually every year in December. And we've got a benchmark now for 2020. These rates have been established and published by the PUC. For each customer rate class, again, small, medium, large, that would be receiving the credit, and across each of the utilities that we talked about to begin with. So for a small account that's in Central Maine Power Service Territory, the billing credit rate for a kilowatt hour, or in this case, a megawatt hour, delivered to the electricity grid by a qualified solar project would convert into a 13 cent per kilowatt hour or $130 per megawatt hour credit on your bill. And this is really the primary driver of this opportunity, that value in the billing rate, bill credit rate. So that summarized the legislation. I'm going to switch now just to talk about how that converts into an opportunity for you as an electricity customer. And this is where we start to bring in, the 3 major players in this type of contract and program that make this all work. First, we'll just follow the 3-legged stool here, or 2-legged stool, I should say. starting with the project. And the project is, in this case, the solar facility that once operational is or would be delivering the electricity to the utility grid. And the utility actually takes ownership of the energy delivered to its grid. Under the energy billing program, the utility takes that kilowatt hour and converts it into a credit. And that credit is based on the energy billing rate multiplied by the volume of kilowatt hours. And what lands on the customer side is a dollar credit, a negative value applied against the charges on the electricity bill, offsetting some of your utility costs. And in exchange for that credit on the bill, the client or customer would be paying back the project for that credit. And the payment going back to the project is obviously part of the contract. You'd sign the energy billing credits agreement with a developer that they would take then to finance and construct the project. They take that contract out to the market, finance, build the project, and that initiates the cycle here. So project puts electricity onto the grid converts that electricity to a credit on your bill. As a customer, you pay a portion of that credit back to the project. In this example on the bottom, 1,000 megawatt hours generated over the course of a month. The billing credit rate being $120 per megawatt hour reduces your monthly charges by $120,000. You've agreed to pay, in this example, $100 per megawatt hour generated by the project back to the project, netting $20,000 of benefit to you out of thin air. So let's talk about that contract. That's really the important piece and the vehicle to get this process started. I told you at the beginning you have to kind of unlearn everything you knew about solar, because the typical structure here is that there's going to be a third party that finances, constructs, owns, and operates this solar facility, 5 megawatt scale, somewhere within the utility's distribution service territory. Whether you're, this is relevant to some of the public entities that have no federal tax liability, that third party is going to monetize some of the federal tax benefits associated with the purchase of the paneling and panel equipment, thus reducing part of the overall cost of the project and passing that benefit through to you. However, these contracts do require a long-term commitment, typically 20 years, which is consistent with the term of the LD 1711 and the legislation for energy billing. So an appropriate term is 20 years for these contracts. And by doing so, ultimately, you're going to help this developer to finance and construct this project. The pricing options for these credits come in a few different varieties. Plain vanilla would be a fixed rate over the 20-year term where you agree to pay $80 or $90 or $100 per megawatt hour generated by the facility over the life of the project or life of the agreement. Some developers will want to have an escalation to that fixed rate, so it increases over time. 1% to 2% is typical. And a third pricing structure we'll talk about a little bit later is a percent discount structure, where rather than a fixed rate for an energy billing credit, the price you would pay to the developer, the solar project owner, I should say, is indexed to the energy billing rate that you receive on your invoice. So that may be, let's say, a 20% discount. And as that rate changes over time, you would maintain that fixed discount to the net energy billing rate. One other important aspect of these projects are the renewable energy credits. There are two options, one where the project owner or developer would retain those credits and environmental attributes, and hopefully they will pay you for those, or a customer can retain ownership of those environmental attributes under this energy billing credit agreement and utilize those credits either for your own carbon emission goals, objectives, or to sell each year into the market. Talk a little bit more about those RECs. I'd mentioned one renewable energy credit is equivalent to a megawatt hour of renewable energy generation. So every time you generate 1,000 kilowatt hours or a megawatt hour, you generate one renewable energy credit. There is, in essence, we'll call it a banking system where those credits are transferred from the producer, in this case, a project owner, to an end user if you do own those credits within this agreement. And so there is an administrative process to take ownership of them, but it is, in essence, a piece of paper that says, I own the rights to these credits. And once you have that piece of paper, you can put it in the filing cabinet or retire it, in other words, and make the claims associated with that megawatt hour of electricity and the associated carbon that was offset as a result of that megawatt hour produced. The second option you have when you own these renewable energy credits is to sell them. There's a very liquid marketplace for these credits. There are buyers obligated by really state policy and compliance obligations under the Renewable Portfolio Standard, which is a separate piece of legislation, but dictates the minimum amount of electricity coming from renewables. And for a power plant, let's say, that's natural gas fired, that has a 40% obligation to deliver renewable energy, they have to go out and source these renewable energy credits. They have to buy them to offset the balance of their generation. And those end up being the compliance buyers for these credits. So there is value, very liquid marketplace, and based on state policies right now, these RECs carry a very high relative value. A solar credit, for example, generated in the state of Maine can be sold into Massachusetts or Connecticut marketplaces where they're worth $30 to $40 per megawatt hour, or 3 to 4 cents a kilowatt hour. So this is a very significant portion of the value for those that seek to retain the attributes and then perhaps use that revenue to fund other decarbonizing goals. For example, other fuel conversions or other projects at your facility that could help to reduce consumption or carbon. Talk a little bit about the economics of these projects. When, again, the best we've seen are when the projects are built at the largest scale possible, 5 megawatts. We've, in this example, or over the life of these contracts, we might expect the billing credit rate to stay at about, let's say, $125 on average over the course of over the next 20 years. There'll be some variations, but we'll make that assumption. And that any customer could go out and buy these credits at $95 a megawatt hour. Well, for every 1,000 megawatt hours that you agree to purchase, or that you can, in essence, monetize through your CMP bill, that will generate $30,000 in annual benefit under those assumptions. In addition to that, we mentioned the renewable attributes. Those we might project $20 per megawatt hour in value over the next 20 years, which would generate another $20,000 in revenue if a customer elected to sell those credits. So for every 1,000 megawatt hours of commitment or a 1,000,000 kilowatt hour commitment, we project about $50,000 in potential savings each year. Okay, important to note that the credit rates and the REC value will change over time, but we think this is probably a conservative estimate as to what could be achieved through these programs. And this is really why there's been so much activity and interest, because you can both save money and meet renewable energy objectives. And under prior legislation, that just was not possible. Okay, got a good couple questions rolling in, and I will be answering them. So thanks, Craig and Ken. I got a spot for both of them. Well, actually, let me address the Massachusetts SRECs. Ken, you brought this up and noted in this table the value of a Massachusetts solar renewable energy credit. And Massachusetts did have a policy that did resemble what we have now in Maine. In fact, Maine was likely modeled off of what happened in Massachusetts. But there is a very, very strong incentive in Massachusetts and to build these projects. This was probably the highest value that we ever saw, the $400. But that's a real number that some customers realized when in the first stages of that program for projects that were built within the state of Massachusetts, that Mass SREC was $300 or worth $300 or more. I mean, 30 cents a kilowatt hour. And that led to very rapid development, which was really the goal of the program. And that's expensive legislation and an expensive price point ultimately. But it led to quick build out of solar, and really the state objective was to do exactly that. But there is obviously a cost to ratepayers in establishing a structure like that. We here in Maine are expecting our solar to be worth really the same value as the Massachusetts market in that $30 to $40 range. So this is a Maine solar credit can be sold into Massachusetts in the $30 to $40 range, but a solar project that's within the state of Massachusetts can receive that higher Mass SREC value. So I wanted to move through to a couple of case studies. Some of the stuff that we've been working on over the course of the past year. About a year ago, we started talking to some of our largest and key clients here in the state of Maine, and put together 25 of them into a pretty diverse group of buyers representing over 300,000 megawatt hours of electric load annual, which is about 1.5% of Maine's total annual consumption, electricity consumption. And what we did was we leveraged that buying group in a large-scale RFP, reaching out to all of the developer contacts we've made working in Massachusetts and Rhode Island markets over the past decade, and also some national and local developers as well, to solicit proposals to provide ultimately bill credit proposals to this group of potential buyers. in that RFP process, we had responses from 18 different solar developers. And for perspective, I mean, there was probably 3 solar developers in the state of Maine prior to last year. But just to give you a sense of the level of interest under this new legislation, we had responses from 18, and there's probably at least a dozen more that are working in the state now. So call it 30 different solar development companies that have moved here to take advantage of these opportunities. And what we had was a good group of proposals. Over 100 different projects were proposed. We ended up entering contracts with 7 different developers representing over 30, what will be 30 new solar, 5-megawatt solar facilities all throughout the state. There were a few actual hydro projects that qualified as well. But overall, about 140 megawatts of capacity will be built here as a result of this project, eliminating over 62,000 metric tons of carbon dioxide equivalent. And we did this all during COVID-19. I mean, it's a very challenging time, as you can imagine, over the past 6 months to be entering 20-year contracts for bill credits. But each of our 25 members ultimately executed contracts with roughly 24 different projects, so that they will be receiving, each of the 25 members will be receiving credits from 25 unique projects. So we had over 700 agreements that needed to be executed, and did so over the past few months. So it was a fun project. Well, fingers crossed, we're nearly finished, and one of the benefits of the hydro is that we've already seen some of these credits starting to flow through the utility bills. These are existing hydro facilities that generated immediate credits going to these buyers. So that'll be very helpful over the coming months. You may have heard about one of those participants, the city of Portland, who did a press release about this, I think back in maybe April. They had made a commitment to 20,000 megawatt hours of renewable generation. That was about 70% of their total load. Had a lot of support from the city council, and ultimately, this is going to help them move towards their renewable energy objectives, carbon reduction goals that they've established. And as a side benefit, they're going to realize over $1 million per year in savings projected once all these projects are operational. So quite a story there. One other recent news article you may have seen was with regard to Maine Health. This is a CES client that we took out under a separate RFP process, and largest single client entering into 11 unique 5-megawatt solar project agreements, 3 developers, and I think it was actually closer to 70,000 megawatt hours per year of commitment there, which will offset over half of all of their hospital portfolio's electric load. So, between those 2 projects, certainly the bulk of our activity, but we've got a number of other individual clients and consortiums, I should say, smaller groups of buyers that we're still working on. And this is where I wanted to talk a little bit about the services that we're offering to support folks like yourselves that may be interested. I think in addition to a bit of a sales pitch here, which I apologize in advance, it's just part of my job, but it may also be useful to listen and understand what exactly the mechanics of this program are going to lead to in terms of work. We've really put together a service that we think is both unique and necessary to support these contracts. So I'll tell you a little bit about how this is going to work. And what we've done is really applied a lot of our procurement principles to the selection and RFP process here, which are to have diversity in who you work with, cast a broad net in the marketplace, find out really which developers are real, which are we would have less confidence in, and also in doing so find really the best prices available in the marketplace. And I'll tell you, it's a bit of a chore, but we communicate at this point probably weekly with 1 to 2 dozen different solar developers. So for any individual trying to get a broad perspective from the market, that's difficult to do, but it's part of our work and part of our value proposition. We're giving constant feedback to these developers so they know where the market is, how they stack up against their competition, and ultimately we're trying to get them to understand what range we need to move forward. There's a lot of attention to the project detail, where each of these projects will have some development milestones, whether it's permitting, environmental, or most important is maybe the interconnection stage. Each of these milestones carries with it a bit of de-risking, a de-risk element to it. And so, for anything that's achieved a certain stage, we certainly appreciate and are looking for those to improve likelihood of development or ultimately of construction. At CES, we've really established a template for the contract, an energy billing credit agreement. We believe is customer or buyer friendly. It is also, we know, financeable. We've got at least a dozen or more developers that have financed projects under the agreement. And so we are a representative of our customers in putting an agreement in place that we believe is valuable and will perform over time. And we're constantly learning. This is something we're humble about. Certainly, we're not immune from making mistakes, but we've spent the past 6 or 7 years doing this work in other markets, and so we've got a bit of a head start here. This is not new to us. It's certainly a new market, but this is where we're most comfortable. We're a Maine-based company, and certainly we're prepared for this legislation and what we would do to support our customers. Once that RFP process is run, we do work and help our customers negotiate the bill credit agreement. That can be an exchange again with between the attorneys and developers, but we've got a supporting work around that, working in our customers' interest to really facilitate that contract. One of the questions that was brought up earlier was with relation to risk and how the fixed price billing credit agreement might compare to a percent discount structure. So this next couple of slides, Craig, will hopefully answer or begin to answer that question. But we're also helping our customers with the modeling and economic analysis on over the next 20 years, how are these agreements going to perform? And to do so, we utilize our own modeling on energy costs, delivery rates, state and regional policy and program costs that all impact the price of electricity and will ultimately impact the billing credit rate, the credit rate that you receive for these megawatt hours produced. And under a fixed price agreement where, let's say, you agree to pay $100 per megawatt hour for these credits, the risk to you is if the billing credit rate approaches or drops below that $100 mark, where you may be receiving less benefit for the bill credit than you have to pay to the developer, which is a not ideal situation. the protection against that risk is, as I mentioned, in this percent discount structure, where that credit, or the payment back to the developer, I should say, is indexed to the billing credit rate. So in this example, that 20% discount will float over time and will perform well in an environment where there are low credit values, where you have very, the lesser credit rates, you'll perform better. But as that credit rate escalates over time, you're giving up or sacrificing some of the upside potential, and that goes in the developer's pocket. And so really what we help to measure and analyze is what type of structure suits each customer best, and where those risks lie relative to your tolerance or risk profile. All right, so this is where things get a little bit nitty gritty, but I'll go through this quickly so we can get to some more questions and let you go on your way for the day. But really the work that we do once the contracts, the net energy billing credit agreements are executed is probably the most important. And I just want to highlight exactly what happens. This is the sausage factory. This is how the stuff gets made here. This is how these credits get made. And so, we take this very seriously, making sure that these agreements perform over time. 20 years is a very long agreement, and there's a lot of detail and complexity to these credits. If I haven't confused you thoroughly, then you'll maybe disagree with me, but for those that I have confused, then you'll probably firmly agree with me here that there's some detail here that needs to be paid attention to. So the starting point for this slide that's in front of you here is, once the project, this solar facility, let's say, is operational. So each month, just like your facility that you may operate, the generator is going to receive essentially a statement from Central Maine Power, and that statement is going to record the volume of megawatt hours or kilowatt hours in this example generated every hour of every day within that billing cycle. And what CES does is we actually go in and get what we call interval data, the hour by hour production data from that facility, to make sure that our starting point, really we can trace these credits all the way from the generation point. So in this example, we have a customer. Let's say this is you. This is your customer. You're the customer. You have and have bought into 10% of this particular generation project. So your utility account will receive a 10% share of the production from this facility every month for 20 years. This facility produces 5,422 kilowatt hours. Your 10% share is 542 kilowatt hours. This is the sausage here. The recipe for the bill credit rate is determined by the Public Utilities Commission, but let's say this is a large CMP account and it receives a 14-cent credit for each of the 542 kilowatt hours, and a total credit going to the customer should be $76.38. Okay, so what we do on a monthly basis and on an account level basis is go in and make sure that sausage recipe is accurate. Each of the credit rates, for example, if that 542 kilowatt hours was being sent to multiple accounts, there would be a different credit rate associated with that kilowatt hour. And what we do then is go and track that through to the customer invoice. This is a real Central Maine Power invoice. The second page, we've actually seen these occur already. Mid-July, this customer received, in addition to all of the same old delivery and demand charges that they always did, there was one new line item added for the net energy billing credit. Just a single line item, no detail. They just subtracted $76 from that bill. So we now know, CES goes and looks at these invoices, and maybe you have one account, maybe you have 10 or 100 accounts that are receiving these credits. But ultimately, we're going to go in and look at that invoice and make sure the credit was received in the appropriate quantity. Next, you're going to receive a developer invoice. This is from the project who said, yep, you agreed to buy these 542 kilowatt hours of credits. We agreed to a price of, let's say, $70 per megawatt hour, and we're sending you a bill now for $56. And the difference there, the $20, is again what you would be netting in benefit. And the other piece to this is that CES would be going in and auditing a developer statement to make sure that it was accurate. And once we did that, once we made sure the developer invoice was accurate and the credit was issued by the utility in the appropriate quantity, we would send out our bill approval report, which says this invoice from the developer is okay to pay. In addition to that, we're going to provide a project generation summary on a quarterly basis that measures the production from each of the facilities which our customers contract, to make sure that that aligns with the contract, make sure the facility is generating appropriately and to the contract specifications. Further, that each of your utility invoices has accrued the credits that were intended to be directed by Central Maine Power to your accounts. And ultimately, one of the most important reports we're going to have is a balance summary for each of your accounts to make sure that under no situation your CMP invoices create or generate a negative balance on the bill. The negative balance is where Central Maine Power is issuing these billing credits greater than the volume of cost on that bill. You develop a negative balance. Meanwhile, you still have obligations to pay the project, the solar project, but you're not extracting any value from that credit received. You have a negative balance. CMP is not going to write you a check. That negative balance will carry for 12 months, and then you'll lose those credits. So an important piece, very important piece to this, especially over a 20-year period, is to audit those statements to make sure that there's no negative balances that are accrued. And then you can, if needed, you can adjust the percentages or volume of credits going to each account. So this is part of the work we do. On a monthly basis, we are auditing about 350 unique utility invoices. We're going to be doubling that as these main projects get online. And we've built a data services team really to support and provide this service to our clients. So that was a sales piece, hopefully a little bit useful to understand, again, how the sausage was made. Hopefully that's not, I don't mean to offend any vegetarians, but that's how that's done. We are, as a company, still supporting new clients that are interested in seeking these bill credits, helping you to evaluate the projects that may be out there, and ultimately, provide the services over the life of these contracts that we think are necessary to support and ensure their success. So appreciate everyone's time today. I would maybe turn this over to some Q&A if anyone would like to jump in either in chat, or I'd take a risk to say anybody that would like to turn their microphone and ask a question, I'd be happy to take that now. And I'm only going to give you another 30 seconds of silence. So for those that know me and know how to get in touch with me, certainly any follow-up questions, look forward to answering those in any format, following up individually. If you'd like, we can apply some of these topics directly to you all and your situations. You know, we can take a look at any proposals you've received and may need help just kind of understanding, you know, again, what's being offered. We look forward to supporting you and appreciate your support and joining us today. Okay, we've got someone that's taken the risk of unmuting themselves. So,
Charlie, this is Craig. I had a quick question regarding RECs. I've had mixed feedback from a number of people giving proposals on those being retained by utilities, like having that being a requirement versus that being available to the customers who are entering into these contracts. Based on what you guys are seeing, like, is there just, do you think there's just a level of confusion there about the regs, or is there like different requirements under different sections of the regs for the rec retaining? I'm just kind of curious there. Obviously, in your presentation here, it appears that they're available.
Yeah, a really good question, Craig, and you've opened up a can of worms I had kept closed during this presentation. The LD 1711 has really two sections within it. One is the net energy billing program, which is largely what I talked about today. There is another section that was added relating to a standard buyer program. And there's really not a whole lot of functional difference in the way that program will work. It is still going to be an on-bill credit, if you will. You know, you enter a long-term agreement with a project. The project produces electricity. The utility takes ownership of that electricity, and ultimately the project creates a credit going to your invoice. However, under the standard buyer program, these developers are there are developers that are bidding into a auction that is being run by the Public Utilities Commission, and in this auction process, they are going to award for commercial and institutional customers 250 megawatts total of project allocations over, I think it'll be 5 different periods. And we're starting with the first period now, where the bids are being submitted, I believe actually maybe closing at the end of the month. The project awards will be made in September. And under this standard buyer program, the developer, the solar project owner, will have an agreement with the Public Utilities Commission. And that it's a slightly different contracting mechanism. The way that program was set up, the renewable energy credits, I believe, will flow to the utility. They will flow to Central Maine Power. And the customers participating have the option to buy them back, in essence. And there's a formula set up to determine what those will cost. But ultimately, you are right, or I should say they are right. There is another scenario where you may not have the option to retain those renewable energy credits. And I'm happy to go into more detail on that with you at another time. So under the standard buyer program, there's more limitation to ownership of the renewable attributes. But good question. Well, good. Hopefully that was satisfying, being 1 o'clock. Thanks everyone for your time. Stay cool, enjoy this nice solar day, and please let us know if we can help out with anything. Thanks very much. Bye.
Thanks, Charlie.
Thank you. Thank you. Thank you all.